Welcome everyone. We'll start our lesson today. You all know me, so my name Anjum. I'm going to do today the second lesson on financial management. So during this, we'll first recap, what we learned during our first lesson, and then we'll start our second lesson. So during our first lesson, anything you remember what you learned?
I think that we're doing learning outcome 1, and that includes 4 or 5 modules of analyzing the strategic position of a company. So includes models like Pestel, 5 forces, RBV, resource-based view, that is. And, yes, 2 or 3 more.
Brilliant. Well done. So during our last lesson, we learned about internal, external environment. We discussed about what is the difference between capability and competencies. We discussed about Porter 5 forces. Do you know what sort of the forces 5 forces are?
5 forces are like, I was reading about them, like the supplier powers, for example, or the buying power. There are 5 kinds of forces.
Yes, so bargaining power of supplier, bargaining power of
suppliers,
customers,
yeah,
the rivalry in industry. So,
yes.
5 forces we discussed during last lesson is quite good model to use to betterly understand. And what is the difference between competencies and capabilities?
Competencies are like what we are doing, we are good at, and capability is the ability to do or perform a task, but to do it in a better way is more of a competency, in a professional way.
Well done. So that's capability mean ability to do something, and competencies mean you're quite competent to perform excel without any mistakes. Yes. So so today we'll do lesson 2. Lesson 2 is learning outcome 2. We're supposed to discuss today finance theories and their application to finance decision making. What is meant by decision making? Why we need to make decisions?
Anytime in our organization we are faced with challenges and certain situations, you have to make decisions.
Yes, so decision making means selecting the best option. According to great economist Neil Robin, he mentioned in his book here that we have unlimited wants and limited resources. Nobody in this world can say I have unlimited resources. We have limited resources, unlimited wants, and we need to utilize effectively. We need to find the best option. So these all the finance theory provide us options to make our decisions based on these theory, how well we can use our financial resources to maximize our return. Okay, so the first lesson we discuss about strategic implementation, some techniques, and we discuss about strategic mean is a long-term decision. So long-term, that's a long-term techniques. What techniques we can use it to make our finances more effective and we get maximum return on investment. Portfolio management tool. Portfolio. What is meant by portfolio?
I guess is it a combination of some kind of investment or
well then combination of investment, so that's called portfolio management tool. So there are different tools we use it. We're not really stuck, like everything is putting in shares, so shares is normally expensive, so investing in not one project, investing in different projects, so because they have a different life cycle of these projects. so we can carry on getting cash, So model of these management, objective setting, and today we'll go through balance scorecard model as well, which is quite popular, which is given by one of the great management scholar. So we'll go through these all today, and portfolio theory and risk, what is meant by risk, and we'll discuss some theories today. So any question?
I think we're good to go.
Okay, so we'll start our lesson today. Can you see screen? Yes.
Yes, I can see.
Welcome everyone. We'll start our lesson today. Today lesson learning outcome 2 is understand the key financial theories. There are plenty of theories, so we'll try to be focused. Few theory, those will help us learning outcome. So that's really will focus, because otherwise learning these all the theories is a lot of numericals involved. So we're doing more theoretical bits as well, which is especially in your assignment point of view, you just need to go through. Okay.
Yeah.
Like earlier, very well you mentioned, financial theories are all about dealing with the finance and all about the financial management, how we'll manage our money. So during our first lesson as well, I just mentioned you. So today we'll just a bit recap first. Financial management is a concern with the efficient acquisition, how we'll quickly acquire, deploy, it's mean short-term and the long-term financial resources to ensure the objective of the enterprise or the organization are achieved. So how efficient we quickly, if we get the quickly cash and we can reinvest. Have we heard about opportunity cost?
Yes.
What is meant by?
Opportunity cost is like when we make an investment, so
so when you're investing in one project, you're missing other opportunity. So because your money will be stuck here, so that's why we need to look around. When you giving money to someone, or you're not investing money correctly at the right time, at the right place, and you're not making the right decisions, ultimately you're losing, and the benefit, it will be cost you the opportunity you are going to miss, So that's a huge opportunity cost. Decision must be taken in three key areas: investment, both long-term investment in non-current asset and the short-term investment in working capital. Do we know what by working capital?
Yes, the capital. I mean, the funds which we are using in the current business.
Well done. So day-to-day business we are using, though normally we call current asset, current liability, those are called working capital, or when we'll minus days, inventory turnover days in inventory, trade receivable days, and minus our trade payable days, so we can find the working capital cycle. How quick, we can, normally in a business, we must need to make sure we'll keep, the receivable days lower than the payable days. So we have enough cash, spare, so we can carry on tackling if we have any problem. So finance from the sources, should funds be raised, and the dividend, how should the cash funds be allocated to the shareholder, and how will the value of the business affected by this. So all this we can do under the financial management. Any question?
No, I think good.
Okay, so next slide we'll look goal of financial management. What is the key objective? Whatever the financial theories we are using are key purpose behind organization to maximize profit, minimize cost, and maximize market shares. So maximize the current value per share of the company's existing stock and maximizing the market value of the existing owner equity. Equity means the investment in shares. So how we can maximize?
Which you're right now on. I can see another this learning outcomes screen.
Oh, you can see other learning outcomes. Can you see now?
No.
Okay. So can you see now?
Yes, yes, now visible.
Okay, so maybe it's not, okay, so well done. Thanks for letting me. So this we are looking now. Yes.
Mm-hmm.
So earlier we discussed about financial management, role of financial management. Now we are discussing goal of financial management. So maximize
Mm-hmm.
profit, minimize cost, and maximize market share. That's the really purpose of financial management. So we
Mm-hmm.
need to make sure under the financial management to maximize. So next we're looking balance scorecard. Balance scorecard is a technique which we normally use in under the financial management, other management subjects as well, which is quite good technique. So as the name indicates, the balance scorecard. So fun. We always like last lesson I think so. I gave you example of Nokia. We don't have any more Nokia, or very few people holding the Nokia now, because the reason the director is focused more on the financial perspective. So financial
Mm-hmm.
perspective, cutting the cost, investing in the research and development, you saving money, research and development, what will be happen in the long run? It will be create a problem in your sustainability as an organization. So that's why we need to be look around if we are investing at the time we are putting in the positive direction even that make huge difference. So increase profitability KPI. What is meant by KPI?
KPIs are key performance indicators.
Performance indicator, economics value added, gross margin, return. So all we need to look around in
Mm-hmm.
a financial perspective. What is the industry averages? Yes. What is the economics
Mm-hmm.
growth? What gross margin really we are, return on sale and the cost reductions. All these we need to be look around the financial perspective.
Yeah.
Then next we have a customer perspective. Objective improved customer satisfaction. Key performance indicator customer feedback. So if we'll focus on the financial prospect, want to be economic value, we want increase margin, but our customer not satisfied. So what will be happen? We have a high complaint. Ultimately, in a year or in few years time, in a strategical point of view, in the long run, we are going to not going to get the business which we are getting now if we're not satisfying the customer. So always we need to look around the customer perspective as well. Internal perspective, streamline the processes. If our processes within our organization, those are not not communicate up between different department, ultimately what will be happen? It will create the problem. So key performance indicator, always we need to look around under the internal perspective, reduce waste. If you will say no, it's that's is not bother about these are the papers. What is the, no, not make any difference. Leave the lights on. Yes, so ultimately what will be happen? Internal perspective, we need to make organization more efficient so we can sustain it in our organization. That's is the internal perspective as well is a financial perspective. Some perspective can be interlinked with each other. So all these perspective so we need to look around internal perspective, reduce unit cost, improve sourcing, product quality. So next, innovation, objective continuous improvement. So you think, is it good, we are enough, we are exceeding? Even in the China is maybe, I mean, in the cost wise is less, but it's not mean the China will sustain forever. So continuous improvement. So always we need to look around how we'll improve. So like embedding technology, using technology, providing our customer, our stakeholders, new innovative ideas so they can enjoy. And ultimately uh, uh, number of employees on training, improve quality, product delivery, quantity of employees, suggestions, and the sale per employees. All this we need to look around. The balance scorecard, we need to be balanced. Yes, if we'll just focus on the financial perspective, it means we are going to lose, and in the long run, in the long run perspective, we can't really sustain as an organization. So this model is quite useful. So maybe we can look around any companies, what their KPIs against the industry. If we are short, why we are short, how many years they are in business, we can compare how we can take uh, initiatives. If we have a knowledge management or within our organization in place, and we develop our organization on knowledge, will be ultimately will reduce the cost and will improve financial perspective. We can meet our internal perspective. If we're delivering the goods on right time at the right place with the right cost to customer, or ultimately the customer perspective we can focus as well. Any question?
I think that's good. That's great.
Okay, so next we're looking some theories of capital structure. There are number of theories, so I'll just pick few theories today. So net income theory, net operating income theory. What is the difference between net income and operating income?
Net income is after the deductions. Net operating is, I guess, after the distribution of dividends, I guess.
Yes, all the costs, other than the tax or interest, so that can be operating income, the income from operation, continuous operation. So net income is mean total income.
All right.
These two, when we look our income statement, it shows net operating income and it says net profit at the end. Yes, and with minus our taxes and stuff as well. So these theories is based on basically the logic as well. So theory capital structure, we need to focus on the net income theory, net operating theory, traditional theory. Maybe you learn about or you heard about Miller theory, Modigliani and Miller. That's a quite popular theory as well. Today we'll go through few. So this theory, net income theory, is developed by David and is also known as a fixed cost of capital theory. KE, cost of equity. K stand for cost, E stand for equity theory. According to this theory, a firm can increase the value of the firm, reduce the overall cost of capital by increasing the proportion of debt in its capital structure. Debt is normally cheaper. If you borrow the money from the bank, is it cheaper than if you issue shares to the public, because normally shareholder expecting more than 10 to 15% return on their investment because they are bearing the risk as well. So that's why it is called, this theory is focused on. It is due the fact that the debt is generally cheaper, the source of fund. Interest rate are lower than the dividend rate due to the element of risk. The benefit of tax as the interest is deductive expense for the income tax purposes. So interest is a expense for a business. So that's why net income theory is focused on. So we can portfolio or some proportion of shares, some proportion of debt. Yes. So debt is need to be more than the equity. So we're really not calculating any numericals, but we can use different formula. Total value of the firm V equal to S and D. S is mean equal to market value of shares. EBIT is mean earning before interest and tax. And -1 and KE is represent cost of equity is mean capital. So these formulas we can use for the calculation purposes. So this theory, to test this theory, we can calculate these as well. Computation of the overall cost of the capital or capitalization rate. So we can find, all EBT, earning before interest and tax. V is the value of the, how much is the value of the firm. Overall the cost of the capital. So those we can calculate by using these formulas. So this theory, according to this theory, is cost of equity is higher than the, so cost of debt is normally cheaper than the equity. Next theory is also given by the David, is only the name, and is also known as the irrelevant theory as well. So according to this theory, total market value of the firm is not affected by the changing in the capital structure. The value of the firm in the industry, in the market will stay the same. We are changing ourselves. Yes. Overall, the cost of capital is KO remain the fixed irrespectively debt minus equity mix. According to, again is argue. Yes. So exemption of net income theory, the split of the total A net operating income theory, capitalization between the debt and equity is not essential or irrelevant. Are relevant. Sorry, the equity shareholders and other investors. So market capitalize the value of the firm. Any question?
No, I think that's fine.
Business risk at each level, debt minus equity mix, remain constant. Therefore, overall cost of the capital also remain constant. The corporation income tax does not exist. So they're saying no, it's not exist, here, because we're looking the operating cost here. Tax come after the operations, yeah. After, so we can look around the firm's equity, earning before interest and tax, overall cost of capital. I'll say, we borrow money 5% interest rate, and we paying dividend that cost us 12%. So overall cost we can calculate, the capital which we have in a business. So next, market value of equity capital. So F V minus D. So F is the market value of equity capital. Do we know what is meant by nominal value?
I don't exactly remember.
Nominal value is known as the face value of the shares.
Okay.
Then we have a market value, the value people are willing to pay. Yes.
Okay.
Value always lower than the market value normally. Yes, because in market, if we have a good reputation, so if the company do and they have a bad press in the media like a Facebook, so what will be happen? Their share prices will be down. Market. So that's why we need to look around the market value of equity, value of the firm, total value of the firm in market can be how many millions, and the market value of the debt. How much is the market value of the debt? Debt we have, how much is it 10 million, whatever, yes? So always we need to be to calculate, the total market value, we can calculate the value of the firm by value of the debt. So cost of equity, earning before interest and tax, minus 1 divided by SF, mean is the market value of equity. So we can use this formula to calculate as well. Any question?
No.
Okay, so next, cost of capital, this is all about. Next theory, we're looking the traditional theory. According to this theory, Solomon is mentioned, this theory, the firm can reduce the overall cost of capital or increase the total value of the firm. He's saying no, it's up to the firm can increase or decrease the cost of capital by increasing the debt proportion in its capital structure to the certain limit, because the debt is cheaper, the cost to rising the funds as a compared to the equity. Does it make sense? Yes.
Yes.
Fairly, because they just argue it and then they proved it. So then we'll see what others saying, because everybody is different calculations, so different views about effect of changes in the capital structure. When we change in the capital structure will be effect. So first state, the value of the debt is capital structure, increase the value and decrease the overall cost, because the cost of equity remain the constant or slightly with the debt, but that does not rise the fast enough to offset the advantages of lower cost debt. It takes a time. So like in economics, when we are doing some good thing now in a country, maybe that's not reflect immediate. Yes, it will be reflect eventually, but like, investing money in infrastructure, investing money, all these, education, ultimately this have a positive effect on the economies as well. So that's all we looking either in a firm or as a whole economy as well. So KD, cost of debt, remain constant or rise very negligibly, because it's very less, really we can't find is too much, rise compared to equity. So affect change in the capital structure. Second stage, during the stage there is a range which the V will maximum and the K overall cost will be minimum, and because the increase in the equity due to the increase in the financial risk offset the advantage of using low cost of debt. So third stage V will decrease and the cost overall, so we can look around, will increase, so all these are the options when we are making any decision, so we can look around all the options and we can make decisions, and we can use these theory to analyze our market and the funds we can invest effectively in the market. Any question?
Okay. Good.
So all these formulas we can use. We'll try some numericals, some lessons. Okay, tax is quite Modigliani and Miller theory. This theory is Franz Modigliani and Martin Miller. So they give the approach in the absence of the corporation tax. In the absence of two approaches, in the absence of corporation tax, there is a no tax, and when the corporation tax exists. Like in Middle East, there is a no corporation tax, yes?
Yeah.
They have a policy, you can't withdraw all the money from the country. You have to return and you have to reinvest in that country. Getting taxes mean the government is spending on the welfare of the society, but if the company is spending themselves, is the same thing, yes? Because they have a law, they can't withdraw the money from the country, all the profit, they have to reinvest in up to good percent. So they can only 50-60% profit they can move, the rest they have to invest. So in absence of the corporation tax, according to the approach V and its K cost independently its capital structure, the debt equity makes the firm irrelevant, determine the total value of the firm, because increased use of the debt as a source of finance and KE increase and the advantages of the low cost debt is offset equally we increase in KE. In the opinion of them, two identical firms in respect the capital structure cannot be different market value or the cost of capital due to the stage process. Any question there?
I think we're good.
So is it just all about looking the debt
Yeah.
and you can calculate as well? What is meant by perfect market?
Perfect capital market.
Which is it mean the everything is controlled by the market forces itself. Perfect competition, perfect capital market, yes? So no transportation costs, homogeneous risk class, expected earning before interest, all the firm have a identical risk. It's not every firm can be a different risk, yes, which in the real world can be difficult. So risk in terms of the expected earning before interest and tax should also be identical for the determination of the market value of the shares. So 10% distribution of the earning to the shareholders, no corporation tax, but the later in 1960 time remove this exemption. So M approach, this removed to the tax approach. So they said no, we need to keep in mind the tax as well now. So when the corporation tax originally argument that V and K or remain the constant with the increase the debt if the capital structure does not hold the good when the corporation tax are assumed to exist. They recognize that the V will increase and the KO will decrease with the increase in the debt in the capital structure. So when you have a too much debt in the market, yes, cost can be reduced overall value, but when you're too much debt, you say 90% debt, risk will be dropped, your goodwill of the company, so overall value of the company will be dropped as well.
Yes.
So that's all about all this logic behind it. This. Any question?
That's fine.
Then there is one other approach is called weightage average cost of capital, where we're looking the WACC fund from the equity source and fund from the other source. We pool a fund and use the finance various investment project. and then we calculate the weightage average calculation, calculate the weight of each source of capital and estimate the cost of each source and multiply the weight of each source cost. So sum the result, so we can calculate the result. What is the cost of capital? If we increase this in this, so what effect will be overall value, or what will become the weightage average cost of capital? So capital as this asset pricing model, CAPM. So let's carry on coming capital asset pricing model. Total risk comprise the systematic risk, unsystematic risk. Systematic mean the market wide factors such as state of economy. Unsystematic, the company and the industry specific factor. By holding diversified portfolio, investor can be almost eliminate. So if you have a diversified, you have an investment in shares, you have an investment in others, and you have in different company, you have an investment in oil, you have an investment in IT. So you diversifying it, yes. Your risk will be less. So this is all about security, unsystematic risk, unique, and the systematic risk. So this will be carry on when we moving words towards number of securities will increase, so risk will increase as well. Systematic risk will be highest.
Okay.
Normally we use the word is called beta. Beta is mean the value is the risk factor. Higher the risk, higher the return. So normally in a business we say higher the risk. If the risk factor is coming higher, then the return will be higher. Like selling things in Syria, maybe example, are selling things in very is a security issue. Though there is a return higher, people need food or people need things, but there are the risk involved as well. Next we're looking the business risk. Business risk can be financial gearing and operating gearing, and this can be trade-off. Do we know what is meant by gearing?
Gearing is like maybe debt
divided by equity. So if it's a high debt, so it means high gear. So high ratio, high gearing, like driving in high gear always risky. Yeah. So fixed cost divided by the total cost, we can find the operating gear. And looking the impact of the income effect, operating gear, change in the income before interest and tax, and change in the turnover the previous year, that we can look around the effect as well. Okay, the financial gearing where we're looking the equity gearing plus the long-term debt, and we can divide by the, so we can find this total gearing. Maybe you learn about the gearing ratio itself as well.
Yeah.
So these are called financial gearing. So this is all about the capital structure and the weightage average cost of capital. By introducing it, good effect, debt is cheaper than equity and would cause the weightage average cost of capital to be fall. Bad effect, cost of equity increase because of the financial risk and would cause the weightage average cost of capital to rise. It's one point, it starts rising as well. Need to be balanced. So today we just discuss about all this, our learning outcome 2, which we discuss about some financial theories, net income theories, net operating theories, MMM, weighted average cost of capital. So these are all, and portfolio management mean, debt and equity. We discuss about strategic management model, which is also part of is called balance scorecard model. We can look around various other models as well. Porter 5 forces also model, which we can look around long-term effect as well. Objective setting, whenever we need to set objective, we always need to set the SMART objective. Do we know what is meant by SMART?
Yes, specific, measurable, achievable, And
Yes, well done. Achievable, realistic, and time defined.
yeah.
So all this we need to look around, and portfolio theory and the risk, So we need to measure the risk under the either we have a debt or equity or mixture of more in one type of shares, other type of shares. So all this is called portfolio theory, like we discussed, within. And the risk itself, higher the risk, higher the beta, higher the return will be in the business. So any question?
I think we're good.
I think so we'll keep up to here. So during next lesson, so what I'll do, I'll send you some document to read back in, and we'll start, discussing assignment from next lesson as well.
Okay.
And then we'll move to learning outcome 3. We'll go through our moving averages, seasonal variations, efficient market, and hypothesis, which will go through dividend.
Why don't we do learning outcome 5 after this, so that there is like the first 1, 2,
It's more
1,
theoretical.
2, 3
We're not doing
tasks.
lot of numerical. Yes. So third learning outcome, fourth and the fifth one will do numericals.
Okay, 4 and 5th are numericals.
We'll do numerical, especially on the fifth one, and we can do some no, on the fourth one is no numericals really. We can look around the wealth maximization, and we'll look some case studies as well. I'll send you a few case studies to read.
Okay, so when we will be ready for doing this assignment? Some part of the assignment or the whole complete assignment?
So whole assignment. So you can start your writing your assignment.